No one knows when or why the next sell off or market downturn is really going to happen. But of course, we can put some money in some ETFs, really safeguarding and really ultra safe ETFs to make a big difference when it comes to the downturn. Now, when we look at a market correction, they consider it a 10% or greater really drop from the high. Now, we have seen 2 years of very high highs. So correction is inevitable. Just at what point? Now, normal corrections come about every 1.85 years, and a bear market, which has a drawdown at least 20%, happens every 3.6 years. So we've already had 2 years of solid growth. It might be time to see a little bit of a pullback in the market. Now, overall, when it comes to a pullback, it isn't that bad. When you think of a pullback, it gives you an amazing opportunity to buy discounted ETFs. And I want to look at the value ETFs today. Normally we look at the VO or the Vanguard S&P 500, but this is really value. When we think of Warren Buffett, he always talks about looking for companies that offer value. They have created entire ETFs that are value ETFs, not that is tracking, so much of the tech sector. And that is what I want to break down in this video. But before we get into it, please subscribe to the channel and let me know what you guys think about the content we're putting out. Now, when we start looking at companies that have a very strong business model, reasonable valuations. Now, when we think of tech companies, most of them have a price to earnings ratio, which is kind of crazy. It has gotten out of control over the last couple of years, especially with the rise of artificial intelligence. Now, when we start thinking of those larger companies, the Apple, the Nvidias, the Googles, they are mega stock companies. And if you're holding any of those ETFs that are even tech ETFs, most of the time, majority of it is going to be tied up. I'm talking 20, 30, 40% of what you're putting into that ETF is going to be tied up in those companies itself. Now, thinking of more of the value, there is a Vanguard S&P 500 value ETF. There is also a Vanguard Russell 2000 value ETF, and there's also a Vanguard Consumer Staples ETF. All are worth buying in 2025, even if there is a market sell-off. These have a lot more protection because of what they're actually invested into. So the first one we're going to look at is the Vanguard S&P 500 Value ETF. Now, when we think of this fund, it targets companies that bring an incredible amount of value. We're talking about Berkshire Hathaway, JP Morgan, Exxon, Walmart, and many more for the top holdings that are not really focused and really honed in on that tech sector, which of course we know can be extremely, extremely volatile. Now, of course, we know some like Berkshire Hathaway don't pay dividends, but overall they keep repurchasing their own stock, really growing the earnings per share because there are less stocks or less shares outstanding. Now, when we start thinking about this in the S&P 500, it has a price to earning ratio of 20.3, far lower than we normally see when it comes to the regular S&P 500, dividend yield of a 1.9, and of course, the Vanguard S&P 500 ETF is one that I am invested in. I'm not invested in the value side, but when we start breaking it down, just listen to some of these numbers. When we think of the value side, in the value, the Vanguard S&P 500, the value, financials make up 25%. In the regular S&P fund, it is only 13%. So you're almost doubling what we carry in that value because, of course, financials, when it comes to healthcare, they are staples and there are more companies, again, that are not so tech heavy. Now, the big thing to note with this one is coming to the value ETF, technology is only 7.7. When we think of those mega cap companies in the regular S&P 500, it amounts to 31% of the entire ETF. Crazy to think that it is 31%, over 31% in the regular VOO, the Vanguard S&P 500 versus the value. This is where you do get the value. So by not holding companies such as Apple, Microsoft, Nvidia, and also those holding some of those discretionary leaders, looking at Amazon, Tesla, or communication giants, Alphabet, Meta, the Vanguard S&P 500 value is considered underweight in technology, consumer discretionary spending, and communications when you look relative to the S&P 500 itself. Now, value stocks tend to be based and really do a lot better when it comes to the growth and the earnings, the very solid earnings, than we see with the growth potential of these mega cap and these AI companies, which is the reason why putting your position into a value versus the growth aspect in a down market, you're not going to see these ETFs go quite as far down as we see with the traditional ETFs. Now, looking at the Vanguard Russell 2000 Value ETF, and again, this is very similar. It is the diversification. It is a low-cost fund, but this is based on the Russell 2000 versus it being based on the S&P 500. This ETF has 1,446 holdings No single stock makes up more than a 0.6%. You want to talk about diversification? You have almost 1,500 stocks holding no more than a 0.6%. So you're talking micro fractional shares of this Russell 2000. Rather than targeting flashy names, the fund is about value and about different sizes across the US market. So very similar to the Russell 2000, which tracks the small cap. This really looks and it filters out about 500 of those small cap companies, looking and really having a guideline with a concentration on a handful of names that are particularly high in the value. Sometimes, of course, too much diversification can be a bad thing. With an exceptional outperformance of a single stock, could get lost really in the wash if someone is doing incredibly well. When we start thinking of this, there is never anything in the Russell 2000 value could increase threefold in a single year, but it would never even move the index more than 2%. So again, thinking of the ETF and thinking of the companies that are comprised of this Russell 2000, it does make a big difference. Even if there's a breakout company, you're not going to see quite the pull that we see, with an Apple, with an Nvidia, with these mega stock companies that can really move the market almost by themselves. However, the fund is a great fit looking for a basket of stocks and also generating passive income. The price earning ratio 14.2, which is good. Yield of 1.7, so you are getting a little bit of a return there. And it is diversification and values focused. Now, the last ETF that we're going to look at is the Vanguard Consumer Staples. Now, this, of course, is one that we've looked at for quite a while. It mirrors the performance of the consumer staples sector. When you think of things that you use every single day, and again, I go back to Warren Buffett where he says, you should invest in things that you are using. This is where it is. 46% of the fund is invested in Costco, Procter & Gamble, Walmart, and Coca-Cola. When you think about those four companies itself, they own an incredible amount of things that are used in a regular basis. Procter & Gamble, pretty much everything in your bathroom. Even thinking of like laundry detergent, everything of that. Procter & Gamble holds almost all the patents and almost everything. I mean, you throw something like 3M in there, you'd probably have about everything covered. When you think at Coca-Cola, pretty much any fast food place you go to, even restaurants, most of them are serving Coca-Cola. Very few do I ever see serving Pepsi anymore. Most of them have all moved to Coca-Cola. And of course, it is a global company. It is a staple when it comes to what people buy. Even thinking of going to Kroger, going to Walmart, going to any store, it is going to be the staple where people are buying. Now, when you think of staple items, it is very resilient against recession. People will still buy these items because, again, they are staples. There's always going to demand for retailers like Costco, even looking at Walmart, Procter & Gamble, Coke. There's always going to be an economy and always going to be people with, regardless of how dynamic the economy gets and how really driven things get within capital markets, consumer spending, things like that, these are always going to be there. They don't keep the pace, of course, with growth-driven rally like we've seen in the last 2 years with this S&P 500, but can perform incredibly well when there is a market sell-off. So when we see a lot of people liquidating or taking profits from these larger companies, the staples will always be there. Even if there's an economic slowdown, consumer staples have always been there and achieve kind of the slow and steady race. That's why, again, when we think of Warren Buffett in his holdings of Coca-Cola, he's held it for, I believe it's been about 50 years right now, which is kind of crazy. The sector does incredibly well, not seeing a crazy amount of profit, but overall still doing incredibly well. When we start looking this, the staple, the P&E is lower than the S&P 500, 24.8, yields higher for a return at 2.5%. And when you start thinking again of value and focusing on value, these are going to be 3 ETFs that have a lot of value, especially when it comes to the down market. So, all right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.